Picture this. You wake up, you check your bank account, you own nothing, no investments, no assets, maybe a little debt, maybe just enough income to survive. And the headlines? AI is replacing jobs, interest rates are unpredictable, housing prices still look disconnected from reality. Everyone online is arguing about whether we're heading into a boom or a recession. Most people look at that environment and freeze. But if I woke up in 2026 with $0 invested, I would actually feel relieved, because starting at zero removes complexity. No messy portfolio, no ego trades, no emotional attachment to bad decisions. Just math, just behavior, just a clean slate. And if you understand how compounding really works, and more importantly, how human psychology sabotages it, then 2026 isn't a disadvantage. It's an entry point. In the next few minutes, I'm going to walk you through the exact 4-phase system I would use to go from $0 to my first $100,000, and eventually much more in this specific economic environment. No hype, no lottery ticket trades, just a strategy that works because it's built on probability. Here's the part most people miss. Starting at zero is powerful. When you already have money invested, you bring baggage with it. You anchor to prices, you defend bad picks, you refuse to sell losers because it feels like admitting defeat. You diversify too early because you're afraid to be wrong. At zero, none of that exists. No sunk cost bias, no emotional attachment, no overcomplication. You're not managing wealth, you're building it. And building is simpler than maintaining. You don't need 12 ETFs, you don't need private equity, you don't need to predict what the Fed will do next quarter. You need a sequence, a clean order of operations that removes decision fatigue. Because wealth doesn't usually fail due to lack of intelligence, it fails due to behavior.
So if we're starting fresh in 2026, we're going to build this in layers. Each layer protects the next. Each step earns the right to move forward. Phase 1 isn't exciting, but it determines everything. If I'm starting at zero in 2026, I'm not an investor yet. I'm a debt eliminator. Because high-interest debt is negative compounding. It's investing in reverse. Let's say you're carrying $5,000 on a credit card at 24%. That interest doesn't care about market cycles. It doesn't care about recessions. It compounds every single month. Paying that off is a guaranteed 24% return. You will not find that kind of risk-free return in the stock market. And here's where people rationalize. They say, what if my investments earn 10%? Math doesn't work that way. If your debt costs 24% and your investments earn 10%, you're still losing 14% in spread. That's like trying to fill a leaking bucket without fixing the hole. So phase 1 is simple. List every liability by interest rate, highest to lowest. Ignore balances. Attack the highest rate first. Minimums on everything else. Every extra dollar goes to the top line. This is the avalanche method. It's not emotional, it's mathematical. And here's the deeper truth. Debt doesn't just cost interest, it costs optionality. When you owe money, you tolerate bad jobs, you avoid risk, you make defensive decisions. Clearing high-interest debt isn't just financial cleanup, it's removing gravity. Once that gravity is gone, we move to protection. Now that the debt is gone, most people rush straight into the market. That's a mistake. Before we build wealth, we build insulation. Because the biggest destroyer of compounding isn't volatility, it's being forced to sell at the wrong time.
Imagine you invest everything. The market drops 20%, which it does regularly. The same month, your car dies, or your company does layoffs. Now you need cash, but all your money is tied up in assets that are down. So you sell. You lock in losses. You reset your compounding clock back to zero. That's avoidable. This is why I build what I call a cash firewall. 3 months of bare minimum survival expenses, rent, food, utilities, transportation, nothing extra. Not invested, not chasing yield, just liquid and boring. People hate this phase because it feels slow. The account doesn't explode upward, it just sits there. Good. Its job isn't growth, its job is protection. When you have a buffer, you think differently. You negotiate differently. You invest differently. You're not desperate. And when markets drop, instead of panic, you see opportunity. Now,
With debt gone and protection in place, we can finally build the engine. Now we invest. And this is where most people overcomplicate everything. They start researching individual stocks, they download trading apps, they chase whatever AI company is trending that week. It feels productive, it feels intelligent. Statistically, it's a mistake. Over long periods, the majority of professional fund managers fail to beat the broad market. These are people with teams, data terminals, and full-time research staff. If they struggle to consistently outperform, the odds of doing it casually on evenings and weekends are slim. So instead of trying to find the needle in the haystack, buy the haystack. Broad, low-cost index funds give you exposure to the entire market. Historically, the market has returned around 8 to 10% annually before inflation over long stretches. Not every year, but over time.
And here's the key. Early on, reliability beats excitement. My structure is simple. 90% in broad index funds, automated, untouched. 10% and only 10% for speculation if you feel the itch. That small satellite keeps your brain entertained without risking your financial life. Because good investing should feel boring. If it's thrilling, you're probably gambling. Automation is the advantage. Consistency is the advantage. Average performance compounded for decades makes people wealthy. But where you invest matters almost as much as what you invest in. You can do everything right, pick index funds, automate investments, stay disciplined, and still lose a massive chunk of your wealth. How? Taxes. Most beginners open a standard brokerage account because it's easy. Link bank, buy ETF, done. But that convenience comes at a cost. Every dividend gets taxed. Every profitable sale gets taxed. Over 20 or 30 years, that drag compounds just like returns do, except in the wrong direction. So before I invest heavily, I look at where my money lives, because the government actually gives you legal shelters for wealth building. You just have to use them in the right order. The sequence matters. First, contribute to your 401k up to the employer match. That's an immediate 100% return on that portion. There is no market strategy that beats free money. Second, max out a Roth IRA. Growth is tax-free if you follow the rules. Third, if eligible, fund an HSA. It's triple tax advantaged: contribution, growth, and qualified withdrawals. Fourth, return to the 401k and continue filling it. Only after those buckets are full do I touch a taxable account. Choosing the right account can mean tens of thousands of dollars difference over decades. Same investments, different outcome. Now here's the accelerator most people ignore. Up to this point, everything we've talked about is optimization. But optimization has limits. You can only cut expenses so far. You can only squeeze so much efficiency out of taxes. There's a floor to how little you can spend. There is no ceiling to how much you can earn. This is where most people stay defensive. They obsess over small savings, the latte math, coupon logic. And yes, wasteful spending matters, but you cannot budget your way to wealth on a capped income. If you make $50,000 and save 20%, that's $10,000 a year, solid. If you increase your income to $80,000 and keep the same lifestyle, that same 20% becomes $16,000 a year. That difference compounds for decades. So instead of asking, how do I save $5, ask, how do I earn $5,000? The highest return asset you can invest in early is your skill set. Identify one skill that increases your market value: sales, data analysis, technical tools, communication, leadership, and dedicate one focused hour per day to improving it. 6 months of concentrated effort can change your earning trajectory. And when your income grows, every step we discussed, investing, tax shields, compounding, accelerates. Defense keeps you alive. Offense builds wealth. Let's bring this all together. If I woke up in 2026 with $0 invested, this is the exact sequence I follow. Step 1, eliminate high-interest debt. Anything above market returns is reverse investing. Kill the negative compounding first. Step 2, build a 3-month cash firewall. Protection against forced selling, protection against panic, stability before growth. Step 3,
Automate broad index investing using a 90-10 structure. 90% reliable, 10% optional risk. Boring on purpose. Step 4. Prioritize tax-advantaged accounts using the waterfall method. 401k match to Roth IRA to HSA back to 401k. Tax strategy isn't advanced, it's foundational. Step 5. Aggressively increase your income ceiling. Skills scale, budget cuts don't. That's it. No exotic asset classes, no prediction of interest rates, no next big thing. Just math, behavior, and time. It's not flashy, it's not viral, but if you run this system consistently for a decade, the probability of failure drops dramatically, and that's the real game, stacking probability in your favor. Now here's the part I want from you. Personal finance isn't a religion, it's a framework. Maybe you prefer the snowball method over avalanche. Maybe you lean heavier into international exposure. Maybe you think 3 months of cash is too conservative or not enough. Good. Challenge it. Drop your approach in the comments. I read them because blind spots are expensive, and smart discussion sharpens the strategy for everyone watching. If this breakdown helps simplify the noise around investing in 2026, consider subscribing. The goal here isn't hype, it's clarity. It's building a playbook that actually holds up when markets get uncomfortable. Because wealth isn't built during easy years, it's built during disciplined ones. Thanks for watching, and I'll see you in the next one.